Good afternoon, everyone, and welcome to today's FPN Data Intelligence webinar, VantageScore and FICO, Navigating the Future of Credit Scoring. My name is Danielle Pendleton. I'm the VP of Delivery here at FPN, and I will be your moderator. We're thrilled to have you with us. But before we dive in, I have just a few quick housekeeping notes. Your microphones and cameras are off by default. Any questions that you have are welcome absolutely anytime in the Q&A panel. And this session is being recorded. We will share it with everyone after the session ends today. Today is part one of what we are going to have as a two-part series. In this session, we'll focus on the history and the benefits of VantageScore, including FHFA approval, comparisons to classic FICO, its use in other lending areas, and how it fits into mortgage and pre-qualification processes. Part two, which will be coming in early 2026, will dive deeper into implementation, timing, and adoption strategies. For now, our goal is to build a clear understanding so you can prepare ahead of the competition. We're joined today by two outstanding leaders. Tyler Sawyer is the President and Chief Strategy Officer here at FPN. Tyler has been leading FPN's strategic vision since early 2024, with over 25 years of experience in the mortgage and housing industry. Has a proven track record of transforming businesses and spearheading innovative projects that enhance organizational performance and market position. Prior to FPN, Tyler held key strategic roles at Fannie Mae, Equifax, and Black Knight Financial Services, where he successfully launched solutions across capital markets, rental, real estate, and valuation services. He is joined by Anthony Hutchinson, the Executive VP and Head of Public Affairs at VantageScore. Tony brings nearly 30 years of experience across housing, finance, and public policy. He has played a pivotal role in shaping policies critical to the housing industry, including the Dodd-Frank financial reform law and the qualified mortgage and qualified residential mortgage rulings. Before joining VantageScore, Tony held leadership roles at Freddie Mac, the National Association of Realtors, and Fannie Mae, where he worked extensively on industry relations, emerging markets, and product development. His deep knowledge of both government and industry makes him uniquely positioned to guide today's conversation on the future of credit scoring. We would like to kick things off with an audience poll, so please turn your attention to the screen. I will share that with everyone now. So the question is, and this will help us to better understand using VantageScore, FICO, both, or neither in your processes today. I'll give it just another couple of seconds for everyone to get their vote in. Okay. So what we see is that we are heavily, well, not heavily skewed, maybe 2/3 skewed in the realm of FICO over the combination of FICO and VantageScore. So hopefully that will help us with our conversation today. And with that, we're going to go ahead and get started. Tyler, I will hand it over to you now.
Well, thank you, Danielle. Really appreciate it. And Tony, I'm honored to be here chatting with you today. Certainly that poll that does resonate, and we'll make sure we kind of lean on into the aspects that's going to define, VantageScore a little bit more. And I think, as Danielle talked a little bit about here today, we're going to focus really in on, and I can't help myself because I have two kids in college, kind of that 101 and 201 type of landscape, right? A little bit of that history around what VantageScore is all about, how it works outside and within the mortgage environment, and even in some of that pre-qualification side of the house. So if I kind of think a little bit about the who, what, when, where, why, and how, right? Our emphasis today is really going to be around that who, that where, that why. Part two, we're going to hit on the what, the when, and the how, right? So but we have a lot to get through here today. We're going to do our very best to get through it in that 30 minutes that Danielle talked a little bit about. But if we don't get to it, or we don't hit all of your questions, we'll certainly make sure to capture them and respond back a little bit later on, and do it in part two of this series. So to kind of kick things off just a little bit from our perspective is that, we've had a lot of interest as we're on out there talking with our customers and our vendors. There's a whole lot of interest in terms of what VantageScore is all about within the mortgage think a whole lot of questions around, hey, the when and the how and the what. How we're going to be able to start leveraging this very important, interesting score that is highly predictable in a way that's going to make it all the way through the mortgage ecosystem. Or if it's not all the way through right out of the gate, what are some ways that we can start to take advantage of that? So what we're going to hit on a lot of those different areas and really lean heavily into the expert here. And of course, I have a lot of questions queued up for Tony. And maybe we'll start with a layup here, which is going to be a little bit about that origin story of VantageScore. So, Tony, you expressed that you have a birthday coming around. VantageScore does, of about 20 years, I think this year. So do you mind just sharing with us a little bit about, how VantageScore came to be and why?
Yeah, absolutely. Tyler, thank you so much. It's great to be here. We do have a birthday coming up next February. VantageScore turns 20 years old. And for the folks out there, I know a lot of people already know about us, but there's a good number that don't. VantageScore is an independently operated company that is funded by the three credit reporting bureaus, Experian, Equifax, and TransUnion. They made us specifically to be a competitor towards Fair Isaacs in the marketplace. They felt that there needed to be some level of competition to help drive innovation, not just between Fair Isaacs and another credit score company, but also for themselves. So we have been in the marketplace initially with 4 different algorithms. So out at the onset in 2006, we had VantageScore 1, which was in the marketplace. We progressed a few years later to 2. Around the 2010 area, we moved into VantageScore 3. And then in 2016, 2017, that's when we released VantageScore 4. And that's really important because it was that score that utilized trended data to be able to evaluate consumers. And for the folks that are watching that don't know, credit scores normally look at you at a point in time. So what did Tony's score look like today based on the things that he's done in the past in terms of paying his bill? Well, VantageScore 4.0 doesn't do that. VantageScore 4.0 takes a look at Tony and says, what have you done over the last 24 months? How has your score changed? All of that history plays into the score that comes out on the back end. It really gives a more holistic picture of the consumer and how they're handling their credit obligations. Are they getting better? Are they getting worse? Are they standing pat? The other thing that we did that innovated with VantageScore 4 actually was in VantageScore 3 and now is in 4. We included any utility rental payment data that is in the credit bureau, as well as telecommunications payments into the score. And part of the rationale behind that is our economy is changing and priorities of consumers are changing. So we don't want to be beholden to an algorithm that focuses on whether or not you already have a couple of credit cards and you're paying that, or an auto loan and you're paying that. A lot of the newer consumers have minimal credit cards, may or may not have a card, but they do pay their telecommunications payments on time because everybody has a cell phone that's doing something. They pay their streaming services on time. They need their utilities. So we want to make, and they pay their rent. So we want to make sure the things that really reflect their ability to handle obligations, financial obligations, are counted. And the key is for VantageScore 4.0 for our conversation is what the FHFA has adopted. And that is what they're going to be working towards. But we don't sit on our laurels. That's not the only thing that we do. We're still innovating out in the marketplace. And as I talk about some of the other areas that we're in, I'll mention that we've got a couple of other products for those areas that we're advancing on. That once we get competition, real competition in the mortgage space, I'm sure you'll begin to see competition and more innovation ramp up in that space. But yeah, 20 years in February, we're really excited about that. We want everyone in the mortgage market to be able to use us and really see the predictive power that some of the other financial verticals out there are experiencing. And quite frankly, that the researchers who pay attention, the financial researchers who pay attention to mortgage, are anticipating for the mortgage space.
Yeah, I love that. I mean, I love the trended data aspect of it for sure. I mean, that is such a game changer as far as I'm concerned, to be able to really pinpoint a little bit more interestingly, where they're headed, where they've been, and what that means and how it translates to the score for sure. Now, you mentioned a little bit here, Tony, about some of the other industries where it might have been used, right? Because I know we're here mostly to talk about mortgage, but I think there's a lot of learnings that might have kind of come forth that you've been developing 1, 2, 3, and 4. So can you maybe expand a little bit in terms of where has it been used traditionally? Where have you been able to penetrate it? What type of learnings kind of came on in, and really, what should we use from those learnings as we start getting into the mortgage environment as well?
That's a great question. So for everybody that's participating, we are currently used by 3,700 financial institutions in the country. And that's both financial institutions and fintech. So 3,700. Last year, we put out 42 billion scores. That's billion with a B. So we are really doing just a gangbusters of growth. That was a 55% increase over 2023, and we're expecting to surpass that 42 billion scores in the marketplace in 2025. So the verticals that are using us are credit card, auto loans, and personal loans, and they've been using us since inception. What many folks out there realize, specifically now with VantageScore 4.0, is that it's much more predictive than any of our prior scores and some of the classic scores they've been using in the marketplace. So what you've noticed is that there is a significant shift from many in the marketplace to utilizing our score. One of the biggest was Synchrony. Synchrony Financial, probably about 3 years ago, decided that they wanted to explore changing the use of their credit score. They wanted something that was more predictive. There were other things that were taken into consideration and related to their bottom line, but they wanted a score that was actually going to help them better handle their customers out there. So they started the process by pulling our score in tandem with the classic score that they were using. And they quickly realized the superiority of our score. So they began backing away from the other score. And it took them about 2 years to do this, because it wasn't just on the origination side that they were utilizing the score. They wanted to utilize the score on the capital market side, meaning when they sent their asset-backed securities out to the capital markets, they wanted to make sure their VantageScore would be accepted there. So come forward 3 years, the last 2 years, Synchrony has released more than $3 billion worth of asset securities to the marketplace. And they fully use, and they only use VantageScore. One, they've had no pushback from any investors in the capital market, and they've seen great performance in their portfolio, being able to predict delinquencies quicker and better, really being able to start their loss earlier because they can see the trends, that trended data piece again, of the consumer. Where is the consumer going? So it's really been beneficial. On the automotive side, a lot of you have probably bought cars from Toyota, have bought maybe a secondhand car through Carvana, or if you buy any other cars where you're financing through, say, Exeter or Santander or Global Lending Services. They utilize, the majority of the scores utilized in those transactions is a VantageScore. Most people just don't know. And again, they utilize the score and they pass it all the way through to the asset-backed security space. So I mentioned that we had 42 billion scores in the marketplace last year. Last year, we did about 13 billion in asset-backed securities that utilize either on its own or in tandem with a proprietary score, a VantageScore. We've already surpassed that 13 billion mark. We're at 22 billion at the beginning of December for asset-backed securities offerings using a VantageScore, and it's going to grow even further. And it just shows you that in markets outside of mortgage, we're already being greatly adopted. And the same on the personal loan side, SoFi, Opportune. Those folks are utilizing our scores all the time. And just one more point, if anybody has a Chase credit card or goes to Credit Karma, the scores that are on the Chase journey or on the Credit Karma app are Vantage scores. So 220 million scores last year were sent out to consumers via those and a number of other consumer-focused web applications. The big issue is if you're not reading the disclosure, you don't know is VantageScore. But we're out there and we're growing like gangbusters. We're looking forward to what's going to happen in the mortgage space.
Well, and in the bond market is a lifeblood, right? I mean, in the mortgage space, so much of it is going to be kind of put into a security. So knowing and understanding that bond traders are already comfortable with it, to a high degree, is really going to be able to help, push that forward for sure. Now, one of the questions that I get often asked from a VantageScore perspective, right, is if you're going to Experian or TransUnion or Equifax, right, are you going to have a consistent score? The reason I ask this is, you talked about utility payments, you talked about rental payments, right? And so is it similar to the FICO type score where there's some variances in there? You see certain consistencies, can you talk maybe a little bit about what you're looking at across bureaus?
Yeah, so that's one of the things that is really interesting and very good about VantageScore. There is consistency across all three bureaus. And the reason for that is, one, we license one score model to each of the bureaus. So they're generating our VantageScore 4.0 based on the same model. The other things that we do is we go through each of the bureau's data sets and we scrub attributes to make sure that we're pulling similar attributes across all three. So most people know that some of the bureaus have more robust information around certain attributes than the others. So there will be a small level of variance. But when you take a look just overall, if you're pulling a 720 from Experian, you're getting close to a 720 at TransUnion and Equifax. And what we find is about 90% of the scores that are pulled are right on top of each other. Maybe about 5 or 7% or have a 20-point variance over the three. And again, that is related to having that level of different information. Only a slightly few have anything upwards of 40 points variance, but we work very hard to make sure that that 40-point variance is not there, because that's where we know that cost of funds begin to change in pricing. So we do we focus all the time, and that's the one thing I want everybody to take away. Yeah, we're owned by the three credit reporting companies there, but we're independently operated. The thing that we do every day and twice on Sunday is manage the algorithm. That's all we do. So we're scrubbing the algorithm to make sure that we've got the best information, the most predictive information, so that the scores coming out will be reliable. The reason I make that point is, one, we want our scores to be consistent across all three bureaus, but we also want folks out there to know that we're not just, again, sitting on our laurels. If we find that there is an attribute or attributes that no longer are predictive of the populace out there, we will remove them from our algorithms. We only stick with what is the most predictive for the financials and the consumer out there. Anything that will best serve both markets is what we're looking for.
Fantastic, thank you. Now, I know you've talked a little bit about, the integration into the mortgage environment. And you touched on, kind of FHFA about 3 years ago, kind of giving the thumbs up, and then more importantly, just recently saying, yeah, now it's approved, right? But it's easier said than done. We all know that, right? I think that even I've learned a number of things here, and I've been in the industry for quite some time, just in terms of like consistency, the model around VantageScore. But now we got to get it on out there. So can you talk a little bit about, what needs to happen within that ecosystem? We don't have time frames, and as we said at the onset, we'll circle back a little bit on what we think that might be, but just from a pure implementation layer, like what comes first, second, and third? How do you see these dominoes kind of fall?
Well, we had the first domino fall recently. I don't know how many people paid attention, but on November 17, Fannie Mae and Freddie Mac began disclosing VantageScore for their existing MBS in the marketplace. So going forward, every RMBS that's in the marketplace that's been out there or is going to be produced going forward will have a VantageScore. Why is that important? Because again, that gives investors an opportunity to see how the new score stacks up against the classic. They could have made that determination using the historical data set, but this is something that's on a run basis. So this is part of their everyday work. So we had that milestone fall. The next things that we're waiting for are for the new loan level price adjustment grids to be delivered to the marketplace that include a VantageScore. The one thing that I will tell you is I know that the GSEs are working feverishly to get that done and signed off on by the FHFA, the Federal Housing Finance Agency. Everybody expects to have that done in relative short order. So if it's not published by the end of this year, I would say be prepared for it to be published early next year. And I tell people all the time, we're not going to get a lead up like we normally do with an administration or the GSEs like they did in the past. Like they would normally say, hey, look, in about 3 months, we're going to be publishing the LLPA grids. That's not the way this administration works. You're going to find out via X, probably, that Fannie Mae and Freddie Mac are giving the go sign to begin using it. So what everyone needs to do right now is to begin to get their systems prepared. So prepare your systems. If you're working with external providers that need to update theirs, make sure that they're updating their system, because this thing is going to happen very, very quickly. So the next big block will be this loan level price adjustment grid published. And when that's done, that'll let everybody know that DU and LPA have been updated, and then they're going to tell us deliver.
Yeah, yeah, I love it. Is there anything that would be keeping those portfolio-based companies, maybe some credit unions who might not be selling to the GSEs, from incorporating this like literally today?
No, and in fact, if you're portfolioing your loans, you should be using our score right now for a number of reasons. One, to help you get a better understanding of the performance piece of it, so you'd have a better risk assessment of your portfolio. Two, to ensure that your systems can bring in a VantageScore 4.0, so making sure that your LOS or any of the systems that you have in-house can handle it. The other thing to note is that both VA and about 5 of the federal home loan banks already accept VantageScore. So if you're delivering Veterans Administration packages, you can deliver that with a VantageScore. If you take a look at their guidance, it doesn't say anything about our competitor. It does say that you have to provide a score, but you can provide a VantageScore. And they have indicated that to us as late, or I'm saying as early as last November 2024. So that can occur. The federal home loan banks of Chicago, Cincinnati, Dallas, New York, and San Francisco are able to accept pledged collateral with a VantageScore 4.0. So for your credit unions or anyone who pledges collateral for any of those banks, you can utilize a VantageScore 4.0. There are a couple of credit unions in Texas that are currently doing that. There are a few banks out in San Francisco that are actively doing that. So that's a way that you can utilize the score right now. I would tell folks, if you've got portfolios, get us in, or start bringing us in at origination in tandem so you can see the power of the score, specifically if you've been having problems with consumers falling out of existing GSE guidance, because the VantageScore is going to provide a more robust score. So there may be some opportunities there.
Yeah, that's a great point. I mean, so really what I hear you saying is it's not a matter of when it's going to happen. It's happening already. It has been going on. This is just a matter of time, right? And so, and we, based off the LPA grids, right, that's going to help influence. Are there other influences? I mean, I think about the lender influence. Hey, they're naturally going to want to start consuming VantageScore as well. But then there's consumers. They've been using it in so many different ways. So how are you going about, how is VantageScore kind of going out influencing the lender community, the consumer community, or are you focusing on one or the other?
So to this point, it's all been business to business. So we've been focusing on the lender and the mortgage ecosystem effectively without the realtors, which is I don't want to say is a problem, but that's where we were. We were just trying to get everybody up to speed so they could get prepared, get their systems up to date, so they could take in a VantageScore and begin to offer it in the marketplace. And just so everybody knows, the larger lenders are already out there doing that. They've upgraded their systems. They're bringing in the score in tandem. They're testing their systems. They're using the score against their portfolio, seeing how the performance stacks up, and they're adjusting their risk models. So a lot of the larger players are already set. They're just waiting for Fannie Mae and Freddie Mac to hit the go button. one of the things that we're going to do in 2026 is we're going to focus on this other portion of the ecosystem that really gets out in front of the consumers, and that's the real estate professionals. Those folks are, I don't want to say they're the linchpin to housing, but they're one of the most influential frontline advocates in the marketplace for housing. So we want to make sure that we educate them. So as this continues to roll out, they're not caught unaware, and they can begin to make aware the consumers in the marketplace that you don't just have to look at at our competitor score. You need to know what your Vantage score is, and this is why. So we'll be giving them a lot of the same education that we've been giving the mortgage industry about how we're more predictive, how many more people we include, how many more people we score, and how deep we go into the credit file to build out our algorithm. I think all of those things will be very important to the folks that are bringing the consumer directly into the marketplace. So that's where we're going to focus in 2026. But to this point, it's really been on the business side of mortgage, and that's been for us lenders, the loan origination systems, and that part of the ecosystem that will deliver directly into the GSEs.
Yeah, thank you. No, and another use case that we've had a lot of success with recently here at FPN is really during that pre-qualification side of the house, right? So, as you're going through the pre-qualification piece, it's top of the funnel. Let's get a good understanding of this particular consumer. And a lot of what you just identified as some of the benefits of leveraging the score, very specifically FICO score, 4, is that trended data, is the additional consumers. It gives you that line of sight really upfront. So, regardless of whether or not they're leveraging your competitor or VantageScore all the way through, it seems to fit very nicely in that pre-qualification process, right? And so I just kind of want to get your perspective. Do you see that as a really nice fit during the mortgage execution side to kind of go top of the funnel? Let's get a good understanding of this individual because we got more folks too.
No, I absolutely do, because everybody needs to prepare. Most of the it takes about 90 days really to get a mortgage closed, and especially if you've been dealing with folks that to this point didn't have the best credit, or you didn't have a really good understanding of their credit worthiness. Well, again, you're going to see that there's going to be some movement of consumers, towards that 620 spot that may not have been there. So you want to see that. You want to try to understand who those folks are. The other thing is true too, and I think this is the reason that there is power in our score. A lot of the credit card and auto loan folks have also noticed that there is migration backwards. So some of their super prime consumers, they're coming back when we start taking a look at that trended information. So it's very predictive. And for the folks out there who are new to this, when you do your pre-qual, you want to know how are your consumers now going to stack up in the new regime going forward. Don't just willy-nilly place them in the wastebasket or send them off to some credit correction entity because they're below that 620 threshold. Two things to remember. They've removed the 620 threshold at Fannie Mae, specifically because they know the power of the new trended data. So you do need to begin to really scrutinize some of those clients and begin to queue them up so that you can move them through the funnel. But the other thing is they also have started following what VA and FHA have done, and that is get their guidance updated so they can take in 2 scores. One of the things that we've noticed is that the industry really refers to credit score by our competitor's name, the same way that most of us refer to facial tissue as Kleenex. There are a number of different brands out there, and not everybody is using Kleenex. So not everybody is using our competitor score. A lot more people are beginning to use ours. We're beginning to see that happen in the mortgage space. And I'll throw one more statistic out to the folks here. The year before last, I think we had about 2 to 3 million pulls of VantageScore at origination for mortgage. And that's before the FHFA said, go ahead and begin to participate. That was in 2023. In 2024, we were up to 5.6 million. So still, even before 166% increase. So there were people that were preparing. I don't have the numbers for 2025. I'll get those early next year. So maybe by the time we come back for part 2, that number is going through the roof. So people are pulling VantageScore right now at origination. So these are not portfolios that are being that are being rescored or scored. These are at origination, and everybody's getting their systems up to speed. So I would suggest that everybody out there do the same thing. But for your portfolio folks, if you really want to get a handle on it before you go operational, going to your providers and getting your portfolio scored will show you the power of VantageScore.
Fantastic. Really appreciate it, Tony. You know, a lot of wonderful insights here today. I know we're at that bottom of the hour, and quite frankly, I think we could probably go on for another 30 minutes just on this subject alone, and want to say thank you. But you know, before we depart, I did want to kind of pass to Danielle to see if there's any questions that the group out here might have that we can answer.
So far, the questions that have been raised have been covered. So I will open it to everyone to put in any remaining questions that you still have, and give it a couple of minutes for everybody to put those in.
In the interim, while we're waiting, I would like to let everybody know that we look at everyone as a partner in this space. So if you need to connect to get a better understanding or a more detailed understanding, go through FPN. You can talk to Tyler. You know, he can put you in contact with me, or we can together have an individual conversation to talk about your own individual needs. I've got a feeling that after part 2, there'll be more people that want to do this. But if anybody wants to just get a head start, please feel free. I mean, we'd love to help you get yourselves prepared.
Yeah, thank you for commenting on that, Tony. And certainly I want to kind of put that ditto on out there as well. Please reach out at any time, and we certainly would encourage that discussion.
So it looks like you guys were really thorough, because we don't have any additional questions. So that's going to bring us to the end of today's session. But please don't forget, this is just part 1. We will dive deeper into implementation and timing in part 2 that's going to be coming early next year. So be on the lookout for that. A huge thank you to Tyler and to Tony for sharing their insights today. And like they said, if you'd like to continue the conversation or explore how strategies apply to your organization, please feel free to reach out to any and all of us. We'd love to hear from you. Thanks again for spending time with us today on behalf of the entire team. We appreciate your engagement, and we look forward to seeing you put these insights into action and joining us early next year. Take care, and we will see you next time.